Everyone's betting the US won't default. They'll just print more money, right? But what if I told you that's exactly why your savings are in danger right now? You keep hearing it on the news, in the comments, at the bar. America can't default, we control the money printer. That's the story we're sold. Sometimes not defaulting is the most dangerous thing a country can do to its citizens' savings. Just last week, I watched a viral video. Investors are betting on a US default. In the comments section, total chaos. Some people are convinced that we're about to go full Weimar Republic, hyperinflation, total collapse. Others are laughing it off. Don't worry, the Fed can print their way out of anything. But if you actually look at history and you look at what's happening right now, there's a third outcome nobody's talking about. And it's the one that destroys more wealth than an actual default. So let's break this down. Yes, if you owe money in your own currency, you technically can't default in the traditional sense. But if you solve the problem by printing a ton of new dollars, you don't get a dramatic US default headline. You get something way sneakier. Currency debasement. Your bank balance stays the same, but what you can buy with it falls off a cliff. It's a default by stealth, and it hits everyone holding cash, bonds, or fixed income the hardest. Think of your bank account as an ice sculpture in the sun. It looks the same for a while and then it's gone. But what happens when this stealth default goes unchecked? Look at Weimar Germany. By November 1923, $1 US was worth over 4 trillion marks. Argentina saw inflation hit 5,000% in 1989, with peak rates over 20,000%. Zimbabwe recorded 300% annual inflation according to the IMF. Even here in America, the 1970s saw massive currency debasement. Nobody called it a default, but ask anyone who lived through it, it felt like one. What cost $1 in 1970 costs over $8 today. That's not just inflation, that's systematic wealth transfer. And what caused the 1970s crisis? Energy price shocks, sure, but the real damage came from the government's response. Print money to maintain spending while supply chains broke down. Retail energy prices jumped 26% in just 6 months during the first oil shock, then 56% during the second one. Sound familiar? Our national debt just hit 124% of GDP. The only other time we were leveraged this much was World War II, when we peaked at 119% in 1946. But back then, America was young, growing, and had a post-war economic boom plan. We also had something else, tax rates that actually addressed the debt. Top marginal rates hit 94% by 1944. That's how serious previous generations were about paying down wartime debt. Now, we're running deficits as if we were at war, but all we're fighting is our own appetite for spending, and perhaps each other. The Congressional Budget Office projects federal debt will hit 156% of GDP by 2055. That's $108 trillion growth from $30 trillion to $138 trillion. The government solution? Keep the checks rolling, keep printing, hope the world keeps buying our debt. And when that fails, guess who pays? The guy with dollars sitting in the bank. That's why investors are piling into default insurance. U.S. sovereign credit default swap spreads jumped from 0.3% in 2022 to 4% by April of 23. One-year CDS spreads hit 52 basis points from just 16 at the start of this year. Smart money is hedging against exactly what I'm talking about. Let me ask you, do you feel safer with a pile of cash in your bank right now? You shouldn't. When governments print, they don't send you a bill. They just let prices climb and hope you don't notice. Your savings erode quietly every day. It's what Milton Friedman called taxation without legislation. And in a real crisis, those who only held cash got wiped out while asset owners survived. So who comes out on top? It's never the average guy. The winners are the ones holding real assets, property, productive businesses, income generating real estate. Why? Because as the dollar falls, their assets rise in value. It's the classic heads I win, tails you lose game. And you need to get on the right side of it. I'm seeing this play out in real time. I mean, the comments are loaded with people panicked about inflation. Some are calling for gold. Some are screaming Bitcoin is the new insurance. A lot of people just want a clear, simple answer. What do I do to protect myself when no default just means slow motion wipeout? After 20 years in real estate and helping people navigate these exact situations for the last 16 years, I can tell you what the smart money does. They convert dead cash into income producing assets. They use fixed rate debt smartly. If you can borrow at a low, locked in rate, then inflation becomes your friend. Your payment stays the same while the dollars get cheaper. Smart investors lock in 30-year fixed loans and use rental property depreciation to offset taxes, something Wall Street quietly uses every day. But most people get this completely backwards. You see, when markets are booming, everyone wants to learn how to invest in real estate. When headlines suggest the market might be shifting, doesn't even have to shift, just cause a little bit of doubt, we see the number of people reaching out for help diminish dramatically. People essentially don't want to get back into real estate until prices are high again. They won't say that, but that's what their actions dictate. They ask questions like, how's the market? You see, what they're really asking is, are prices going to go up? Which nobody knows for certain, but just asking that question reveals they're thinking about real estate all wrong. They're focused on just appreciation, which is only one of 4 profit centers in real estate. And honestly, kind of the smallest reason to get involved. Think about it like supply and demand with collectibles. If Pokemon cards are expensive, you don't buy them. If they're cheap, you load up. People get that concept with everything else in life, except real estate. Like when someone says, my water heater blew up, there goes my cash flow for the whole year, they're missing that 3 other profit centers are still working for them, compensating and then some for that repair. You've got appreciation, sure, but you also have cash flow from rent, you have tax deductions and depreciation, money you get to keep that you'd otherwise pay to the government if you didn't own that real estate, and you have amortization, where the tenant literally pays down your mortgage for you. There's no other asset class where someone else buys the investment for you. None. And when you add leverage to all 4 profit centers, you multiply returns in a way that's simply not available to average people in any other investment. So why are most people still terrified of real estate right now? This is exactly why real estate works so well in inflationary environments. While your cash loses purchasing power, your fixed rate debt gets cheaper to pay back. Your rents adjust upward, your property values rise, and your tenant keeps paying down your loan with increasingly cheaper dollars. You're literally positioned on the right side of the currency debasement that's happening, whether we call it a default or not. Look, I get it. Real estate can feel complicated. There are a lot of moving parts sometimes. Most people they don't know where to even start, what type of property to focus on, or how to structure deals properly. And that's normal. I've been doing this for 2 decades and I still learn something new with every transaction I do. If you want to figure this out, you're gonna need to get serious about it. The economy is gonna keep doing what it's doing. You can position yourself to protect your wealth, or you can hope your savings account somehow beats systematic currency debasement. I happen to be meeting with a small group of investors here in Vegas this month, usually about 6 to 10 people. And we spend 2 days in my office going through exactly how to position yourself properly for what's coming. It's not a seminar or anything formal like that, no. More of a working session where we map out specific plans based on each person's situation. We call it getting your real estate investor DNA code. Basically a personalized roadmap that fits your personality and your circumstances. No 2 plans are alike, they're unique to the individual. So if you're serious about this and meet some basic qualifications, if you got a decent credit score, no recent financial disasters, and most importantly, you're ready to actually take action instead of just thinking about it, there's a link below in the description with all of the details. Hey, and if not, that's fine too. Just make sure that you're doing something to protect yourself. This economy isn't going to suddenly start favoring people who keep all their wealth in depreciating dollars. The choice, it's yours, and you know that. But choose quickly, because while everyone's debating whether we're going to default or not, the real wealth transfer, it's already happening. Drop a comment below. Do you think a US default is possible, or is inflation the real threat? Hey, quick thing before you go. I'm running this weird experiment where I basically pay people to do real estate deals for them, and then I split the profits with them 50-50. And you can watch this right here to get all the details. And yeah, I know it's probably the most ridiculous offer that I've ever made, but it's working like crazy. And if you're thinking there's a catch, you would be right. I can only work with 2 to 3 people per city. So if you're curious, check out this video here to see if your market's still open. Or don't. It's not for everyone. Thanks for watching though. I'll see you next time. Take care.